Welcome to Two Guys Whining About Retirement. I'm Troy Frazier, your host, financial advisor. And look, this is the only show where you're going to get a review on a bottle of wine and some great financial conversation along for the ride. Now, joining me is my co-host, Bryan Rose. Bryan is a wine aficionado and a do-it-yourself investor. Bryan, welcome.
Wow, that's a big intro. Thanks. I would call myself a DIY wine guy too. I know what I like, but looking forward to sharing some thoughts on it and some tasting notes, and glad to be here.
Good. So I'll give a little peek into what we're going to talk about before we move on to the wine piece, right? We got to do the important stuff up front.
Yeah, well, we can debate what's important.
Yeah, right. Which one goes first or second, right? So today what we're going to be talking about is inflation. I get a lot of questions about what's the best hedge against inflation, what should we do, this or that. Some crazy ideas out there that I heard people share, but that's what we're going to talk about today. Inflation is going to be our headline. So
bottom line, how do we plan for it?
Right, absolutely. So that's what we're going to cover and go over. But first, we got to get to a little alcohol libations here.
Absolutely.
Can we call it that? Sure.
That's perfect.
So as always, we've already, for time's sake, we've already uncorked the bottle, poured our glasses of wine. I'm going to set the bottle there and let you tell us about it.
This is how we plan for inflation. We drink some wine.
That's right.
So we have a 2019 Alamos Malbec. It's out of Argentina. It's about a $20 bottle of wine, a total wine. You maybe find it a little bit cheaper from time to time, but it's a great bottle of wine. James Suckling gives it 92 points. It's a very fresh and spicy nose with plenty of brambleberries. I don't know what a brambleberry is,
what a brambleberry
but
is.
I'm interested to find out. Notes of violets, balanced spice, baking spices, vanilla, and cloves.
Schnozberry. No, the Bramberry. What'd you call them? Oh, there you go. You're slurping your wine.
Brambleberries.
Brambleberries.
If it's in there, I'm tasting it.
Yeah, it's on Willy Wonka's wall, right?
It is.
Yeah, right.
Definitely getting the cloves over the vanilla, but the vanilla is there on the aftertaste. So it's full bodied. James said it had velvety tannins. I'm not sure I'm going to agree with that. It's a little bite at the end, but it's definitely drinkable.
Too bad. Yeah, absolutely. So I'm going to set this aside for a moment. As always, I don't like to rate it right away. I want to drink it as we go along, give it its fair shot, and then we'll rate it here at the end of the cast here, the broadcast.
So, like I said before, we're dying to know, how do you plan for inflation?
Right. Well, I would just say you drink a lot and hope it doesn't affect you, right?
Yeah.
Inflation is, and I'm going to let you ask me more questions really than go on, because it really depends on your portfolio, how your portfolio is set up. There's not just a magic wand with inflation. It's not like it just affects this sector or that sector. I hear all the time, Troy, what's the best sector? What's this or what's that? So I'm going to have you ask me maybe a few questions on inflation.
Yeah.
And,
is it always bad? Can it be good?
Well, anytime my money buys buys less and less, right? I always think that's bad. So I don't think it's a bad or good. I think it is what it is. And I think that inflation cycles, just like the market goes up and down. I mean, I can give you averages, right, but we may have a 10-year period where inflation is very high, and then all of a sudden it's very low. Right. And it's like saying, hey, I'm going to place 1 foot in the fire and 1 foot in the ice bin, and I'm comfortably, warm in the middle, right?
So how do we protect ourselves against inflation and on one side, but are there opportunities to take advantage of it on the other? Like, how do I balance that as an investor?
Right. I think that what you'll find is that the people that are most worried about inflation, or it affects the most, is those that have the most fixed income in their portfolio.
Got it.
And I think that, for the most part, interest rates are all relative, and equities tend to do okay in inflationary environments. Go back to the 80s, right, where inflation was pretty high. Equities did really well for the most part, during that time. But as we get older, a lot of us out there have more and more that is in fixed income or bonds and those things. Now, how we combat it is that we are managed money. So we're moving the money around. We're looking for the opportunities.
Let the pros handle it.
Yeah, absolutely. Yeah, that's weird coming from a DIY guy.
I know.
Coming
Well,
from I'll say it, the Vanguard guy over here, right? Coming
True,
from the Vanguard
guilty
guy.
as charged. But, as I learn more,
I keep bringing you to the dark side, right? As you learn.
Potentially.
So, here's the thing. We're not using in our portfolio individual bond ladders, things like that. I call that old school.
Okay.
If you go back and you look at a bond ladder or you're in a buy and hold situation, well, what's going to happen is that inflation's really, really going to affect you, and it's going to hurt you pretty bad, right? But as we're buying and selling inside of our exchange-traded funds, inside of our mutual funds, and we're moving those around, there's 19 different bond sectors, and not all react the same here and there, right? So as we're moving around finding the opportunity, we're adjusting for that. And whether we're getting it through yield or through growth, we really don't care. It's all alpha or growth in the portfolio. So that's where you have to be careful, is when you've got the bond ladders, you own individual bonds, because you're going to get your money back at the end of the day, right?
Right.
But what the lost opportunity is you've had the lower yields and you've missed out on all this great growth you could have had in interest rates because you're not buying into those higher yielding instruments.
Okay. So like thinking about my personal wallet, from a personal finance perspective, how can I, maximize my income and to offset inflation and higher prices?
I think that you have to have in your planning. See, it all comes back to planning. You can't get right to inflation and go, oh my gosh, what do I do? Right?
My $12 bottle of wine's now $20.
Right. You got to eat chicken rather than steak or whatever you want to do. It's interesting. I'm going to pull a quote here from I think this is CNBC. Yeah, it is from their website, and this is an article on inflation, and they go, inflation is particularly tough and challenging for retirees who may rely mostly on their investment yields to pay their bills, whereas younger people still have salaries. So my question is, as an advisor that does income planning, I've retired people every day for the last 20 years. I don't have clients living off of their yields and their dividends and those things. That was great in the 70s and 80s and 90s where the market did one thing and that's go straight up. But the last 21 years, we've seen great volatility.
Right.
And why are only the younger people working having salaries? Why aren't the retirees paying themselves a salary? Right? So we pay salaries from our monies.
And salaries that grow, right?
That's right, and salaries that grow.
That's the important thing. You want increasing income, not flat.
That's right. So we usually use 2.6 or 3% a year when we're doing planning. Like I said, inflation's all over the board, but you got to have somewhere to start, right? Yep. So if we've started planning your income here and it increases every year, and then that money we know is coming in no matter what, right? That's our, no matter what goes on, that's coming in. And then we have money in the market that's yielding and is being inflation adjusted. That's then where we're pulling the extra we need during those periods of time, right? Okay. So the market is not an efficient place to get income from. Got it. It's an inflation hedge. It's long term. It's great, but not where you should be delivering your income, because you are going to run into all of these problems. Take that risk out of the picture. And that's where I always talk about our fearless retirement, our 5-step process, right? So if you go to myfearlessretirement.com, you can go through, it's going to show you our process that we do, those 5 steps that removes this totally from your risk from your portfolio. All right. And then you've got a chance to set up a 15, 20-minute consultation with me there that we can see if it works for your situation. MyFearlessRetirement.com.
Well worth the time. Someday I'll get that 15 minutes.
Yeah, someday you might. I don't know. That's,
Definitely.
Then I wouldn't have anybody to ask these questions.
No, I know.
So I got to leave you suffering out there a while.
Okay. On an island.
That's right.
Troy, so it's somewhat related, not exactly inflationary. It's kind of, you hear a lot about the dollar becoming being devalued, becoming worthless. What are your thoughts on that, and how does that impact me as an investor?
My answer to this is probably not going to be real popular, and I say it tongue in cheek. And my clients who know me knows that I'm come from a comedy angle on things. Yeah, it's look, I don't believe that, and I've seen nothing mainstream that's going to show me the dollar is going to become worthless. I think that you could take headlines at any time over the last 100 years, 60 years from the newspaper, and there's always somebody that's crying the dollar's going to be worthless. This is going on. I mean, 5 years ago it was, the Chinese yen or whatever. Now we're going to be, that's what the economy of the world is going to be based off, that we're losing our superpower, our number one, economy.
But their job is to get eyeballs on the screen, not necessarily tell you what's going on.
I have clients, and look, I'd rather for clients to send me this stuff. I get people all the time that, because look, they see the retired folks in this elderly population as the targets. They use scare tactics.
Right.
And people will send me these scare tactic emails all the time. And they're like, Troy, what should we do? This is what they're saying. And every time I go down, and so I spend my money instead of my clients doing it. And I've spent thousands of dollars over the years following these links, buying these reports. And at the end of the day, all they're doing is trying to sell me a monthly report that try to tell me these are the stocks I should be buying. Because, I mean, the story sounds good.
Right.
But at the end of the day, it's really not going to do anything for you.
Right.
And so, I said, I'm looking around while you were talking about that for my colander or my
your
conspiracy theory hat,
exactly. Where's your tracking device?
Yeah, that's right. That's right. It's
but you're a fiduciary, right?
That's correct.
You're
absolutely
obligated to do things in your client's best interest.
Absolutely. And I mean,
these guys are just
right. And look, I could be totally wrong. Look, I mean, it's just not mainstream. I mean, so I may have to, if that's what you believe, I may have to come to your house or whatever. Now, I've invested in a lot of ammo. That's my inflation hedge.
There you go.
So, so I've got ammo. You share your chickens with me and the gold.
Right.
I've got ammo. We'll protect. Perfect. You got to protect the cows first, right? You got to protect the meat first.
Well, meat first, wine second.
That's right.
Let's get that.
That's right.
Speaking of wine, so the wine has mellowed out. It might be time to talk ratings. Like I am pleasantly surprised. It's this tannins have become softer as it's been opened. And what are your thoughts on it?
Well, I think it should breathe a little more, right? So there's no other questions on inflation first, right? We've covered that.
Not exactly. Not directly. I think you're pretty. You covered my questions.
Perfect. So yeah, it's opening up a little bit. I think it's better. It's not a bad. I like red wines. Haven't had a lot of Malbecs, so not real familiar with that. But
it's something that I've started drinking in I mean, they actually grow some in Texas that they're pretty good. Argentina is the hot spot for them. That's a nice offset to between a Cab and a Merlot, in my opinion. I'm not an expert, and I really enjoy them. And there's a lot of good Malbecs, under $20. So. And
what was the price point on this one?
$19.99.
Oh, just the penny.
Under $20.
That's right.
But there's ways to get under that. So
perfect. So how are you going to rate it?
I'm actually going to give it like a solid 4.2.
Okay, so 4.2
4.25.
Okay, I don't even know. I don't even know if our graphics on our corks can do a 4.2.
I don't think you can.
I think we should keep them at half points.
It opened big, but young.
So would you go to 4.5 or stay with 4?
I'm going to stay with 4.
There you go.
And I think the longer we kind of keep going on and on, I don't think we're going to. I think it's going to drink better, but we'll stay with 4 at this point. Opening, after 10 minutes, 15 minutes, it's softened nicely, and I think it's a nice drinkable wine.
I'm going to go with a solid 4 also on this one. I like it very much. Hey, thanks for bringing this in today. This is great, and I think we should continue off air drinking the rest of the bottle.
Absolutely.
All right, thanks for joining us again for Two Guys Whining About Retirement, the only place where you're going to get a review on a bottle of wine and some great financial conversation. We'll see you again next week with a new topic.